Hey, everybody. It's good to be with you today. Happy Wednesday to you. My name is Brent Moores, and time for managing an options portfolio. We do this time each week, and glad to be with you. And let me just mention this. This class immediately follows a trading index options class, which is taught by Ben Watson. I encourage you to check that one out as well. And one reason I mentioned that is Ben's in the chat here helping me out today. So always appreciate Ben. All the subjects matter I'll be covering today, Ben is very knowledgeable with. So as you have questions, feel free to type those questions into the chat, and between Ben and myself, we'll do our best to help you out there. And I appreciate each of you. There's some familiar names in the chat. Glad you're here, and if you're watching on a recording as well, that's great. Glad to have you join us. Let's go through some disclosures, excuse me, before we get too far into this. And then what I want to talk about is a poor man's covered call. What's that? What's a poor man's covered call? Well, we'll talk about that in just a minute here. But just remember, options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any security, chart pattern, or investment strategy. And all investing involves risk, including loss of principal. Paper money software application is for educational purposes only. And spread trading must be done in a margin account. So I mentioned a poor man's covered call. Technically, it's not a covered call, folks. It's actually a spread trade. It's actually a diagonal spread. We'll get to that in just a minute here. But just remember, past performance of any security or strategy does not guarantee future results or success. And there we go. All right. So let me head on over to the Thinkorswim platform. This is the market. This is the S&P 500. It has been just kind of going, just trending up. Nothing stands in its way, it seems like. Now, of course, that can change at some point, but right now, trend traders have probably been pretty happy with the performance of the market. And, one strategy that we often talk about in various webcasts are covered calls. And so I want to talk to you about what a covered call is, what this kind of thing I'm terming I didn't come up with the term, but what we're terming a poor man's covered call, so to speak. What that is. And then also, of course, this is managing your options portfolio. I want to talk about options management. So we're going to hit up some different trades we have in our sample portfolio here and talk about managing those trades here. So I'm going to start off with just an example stock here. It's one that actually we're past earnings on it. Okay, Nike has had a nice little turnaround. Nike over the past few years has had a miserable time, to be very honest. It's been really struggling over the past this is a 3-year chart. You can see what Nike's done. But you can see we've had a nice little change here on this. And that's a 50-week moving average on this chart. And we're above that. So that's basically 50-week is basically 250-day moving average. So we're breaking above that. So that's a nice little change for Nike, and you can see that going up. And if you're bullish, you may, there's different choices you can make. If you're a stock trader, you can buy Nike. If you want to leverage it a little more, you can consider long options or other trades that we talk about in this class. But one approach that people take sometimes is doing a covered call. So I want to talk about doing a covered call. I'm going to use Nike as our example stock, but you can pick whatever stock you're on. Remember, when you're doing a covered call, it's a bullish trade. When you're doing a covered call, you're buying the stock, which we'll say 100 shares of stock has 100 delta, okay? And then you're going to sell a call. Now, it depends what strike you choose, but let's say we do a strike with about a 30 delta on the call. And so your net delta on that covered call is going to be, in this example, about 70. That's quite a bullish trade there on that. So it's true we cap out our gains. And so when you sell a covered call, basically you pick a strike price. Just on this chart, let me just look. I'm just going to say 80 as an example. if we sold a call around 80, we're agreeing to sell the stock for 80. Well, the stock's at 77 right now. That's great. But of course, if the stock goes up to 85 or something, then agreeing to sell it at 80 may not, in hindsight, have been the best idea, but you're still making money in that circumstance that I'm talking about. So that's something, but you get something but for agreeing to give up your stock, and that is you get a premium. So let's look at Nike here as our example. So here's Nike, and I'm going to go out about 30 days here. So I'll go to the August 22nd contracts. And I'm going to look at Delta. Delta tells us how much the option is going to move in relationship to a $1 move in the stock price, but it also gives us a sense maybe for how far, the probabilities of the stock actually going in the money. In this case, that's not necessarily my goal for it to go in the money, although it may not be the worst situation because, again, with the covered call, we own the underlying stock and we're positive delta, and we'd be making money on this. I'm going to look at about a 30 delta here on this. So I'm going to go to the 29 delta. There's no 30 there. I'm going to go to that 29 delta. It's an 81 strike. And the premium we're going to be bringing in, I'll just use the bid price on this, is 108. Now, we may be able to get a little bit more than that bid price, but let's just kind of think about that. Let me just jot that down real quick, 108. In fact, what I'm going to do is I'm going to bring up a little table, and we're going to fill out the table. And the short premium, we're going to say, is $108, okay? $108. What's the stock price on Nike? Well, the stock price on Nike right now is $77.17. It's a little bit of a moving target. That's okay. I'm just going to put that in, $77.17. So the cost is going to be, total cost for 100 shares, $7,717. That's the total cost there, okay? So, and I'll put a dollar sign in there just to be nice and neat and official. And the delta on the stock is, what's a delta on 100 shares of stock? Well, delta on 100 shares of stock is 100. Okay, that's just how that works. So sometimes when we look at these, we may kind of think of, in terms of the premium that we're getting, how much premium are we getting as a percent of the stock price? Because this is basically a month's worth of time. And so, we may look at something that's, often we'll look at something that's 1 or 2% in terms of premium. And you kind of go, you poo-poo that and you go, 1%, that's not very good. Well, keep in mind, that's over 30 days time, and that's a month. Now, it's not that you're going to do this every month in the year, but sometimes if you kind of think of it in terms of that's just 1 month, that may not sound like, that may not be bad. And of course, keep in mind, if we're buying the stock for $77 and we end up selling it for $81, if we got called out, we'd be able to keep the premium. We get that premium, and we get the appreciation in the stock price from 77 to 81. So that total return may not be such a terrible thing. If the stock instead just kind of goes, we'll just say sideways, and the stock does nothing for the month, well, we're bringing in that percent, that 1% or whatever it was. Well, let's figure out that percent. I'm going to go 107. Actually, I wrote down earlier, the price has changed just a little bit here right now. So let me go with this. Let me just move this over, and let's figure out the percent here. So 108 is the premium. I'm going to divide that by my share price for 100 shares is 1.399, 1.4% premium. Okay, 1.4% premium, which is great. The more months we could do that, that can certainly make the difference in a portfolio. That's a great thing. Now, there's downsides to it as well. I mentioned the opportunity cost on that. If we sell that 81 strike, we're obligating ourselves to sell the option for 81. Excuse me, sell the stock for 81. And keep in mind, short options can be assigned early. They certainly can be assigned early. Let's see. Sharon in the chat said, why am I not selling the 15th of August call? Oh, you certainly could. I'm just using an example. I wanted to go out a month to make it easy. You could certainly go out instead of August 22nd, August 15th. You could do the same thing. When you do so, compare what kind of premium you're getting. And so if we look at the 81 call, let's look at the 81 call here, a little less premium. So instead of that 108 premium, we'd be getting about an 81 cent premium. Still over a 1% return, but there's less time for the stock to go awry, so to speak, less time for the stock to go against us. So there's pros and cons depending on what strike price what expiration you do and strike price. So it's not a recommendation, it's just an example. One pro of going to the August 15th is you tend to get better liquidity on the monthly expirations versus the weekly expirations. In this case, let me go back here, not a terrible bid-ask spread. I'm not super concerned with that on there, okay? So just weigh your options on this in terms of expiration date, strike price. The farther out of the money you go, the more potential, the higher you're capping, the higher you're agreeing to sell your stock for, which is kind of nice, but you're compromising that a little bit with the amount of premium you're bringing in on that, okay? So there we go. And so that's your basic covered call. I think a lot of you are familiar with that covered call there. But let's think of this. What if instead of using the stock, 100 shares of stock as kind of the base here, what if instead we did a deep in the money option that is a LEAPS option? So I'm going to go out here, and what I'm going to do is I'm going to go out away. I'll go out 422 days. So this is a LEAPS option. It's over a year out till expiration. Next September, you can actually go out further. There's some further expiration dates there. But for now, I'm going to call that 422. We're going to go out to next September. Okay, so that's out a ways. So kind of the downside on that, these are more expensive options, right? When we go out 422 days, more expensive options. I'm also going to go to a delta that's relatively high. A lot of times on our shorter options, we're going to like a 50 delta or something. I'm going to go out to something that's like a 85 to 90 delta, somewhere in here. I'll go to this 87 delta, 50 strike on this, okay? 50 strike on this. How much is that going to cost? Well, it's kind of a pricey option. A 50 strike, if we were to buy this, is going to be right around $3,000, okay? $3,000. That's, I mean, you may go, well, that's an expensive option, but keep in mind, what's our delta? Our delta on this is 87. So we get 87% of the movement of the stock on this option. But how much is it going to cost us? It's going to cost us less than half the price of the stock. The stock is 76. Well, let's see. The option is $3,000. The stock is 76.85. That means basically we're spending 39% of what it would cost for the stock to do this deep, relatively deep, in the money option, long call, that has an expiration date out over a year from now. Now, this is not a stock, and this is why this is not a covered call I'm going to be talking about here in a sec. One thing is, this does have an expiration, okay? That's certainly something. Okay. Another thing is, if I buy this, I'm not getting a dividend, and Nike does pay a dividend. So those are a couple of differences between the option and the stock. But there are similarities here. In general, as the stock goes up, if we have a longer term bullish outlook on Nike and we're making 80, we have an 88 delta on that, well, that would actually not be a terrible thing if Nike went up. Now, if my long-term outlook on Nike is down, I would not want to do the trade. So how much is that Leaps going to cost? Well, I forgot already. Let's see. Let's take a look. We said it's a $50 strike, $29.90. I'm just going to say I'm going to make it easy. I'm just going to round that up a little bit. And I'm just going to say $3,000 for that. Okay. For the Leaps. That's how much it's going to cost. Because we use a 100 multiplier on that. Okay. On options, unless the standard multiplier is going to be 100. In this case, it's 100. Okay. My delta on that is 87. Okay. So let's do that. Delta is 87. So we're getting almost, not quite, almost the same amount of dollar movement on the Leaps as I am on this stock. Leaps is just a long-term expiration option. Now, is that good or bad? Well, yes and yes. Because if the stock goes up, that leverage is a wonderful thing. If the stock goes down, that leverage is not a wonderful thing. That leverage works against you. So leverage isn't good necessarily. It's if it matches what your portfolio forecast is, if it matches what the needs of your portfolio are. Yes, in hindsight, if you knew that the stock were just going to go up and up, you'd likely leverage it. But we don't live in a world of hindsight, okay? And we don't know what it's going to do. So the short premium, the premium is the same. The short option, in other words, so we're talking about selling the option that's about 30 days out. That's the same. But what's the premium as a percentage of that initial investment? Well, 108 divide, how are we going to do the math here? We're going to take the short premium. Again, this is a 30-day premium. 108 divided by 3,000. And that's about a 3.6% return. Okay, 3.6% return. Now, if we wanted to, we could, there's different variations on this. We could buy a shorter term option. Let's just kind of think about this. If we bought a shorter term option with less time value, that's going to increase that premium as a percentage. Okay. If we go less in the money on it, then that would make it cheaper if it's less in the money. And so that would increase the percentage there. But there's pros and cons. By going out a long ways, here's my Leaps, and pretty deep in the money, 87 delta, what I'm doing is I'm making this more stock-like. It's not a stock. We have expirations, no dividends. It's not a stock by any means. But in terms of movement, it becomes more similar to the underlying stock movement. And if our goal here is to kind of sort of try and mimic to the extent that it is a covered call, we're probably going to go to something more like a deep in the money Leaps contract there. But you can see the leverage on that. It's the premium as a percentage becomes more. So what's our forecast on this trade? Well, long term, we're bullish, right? Why are we bullish long term? Well, we're bullish long term because number one, our delta is still going to be pretty positive. We want, the Leaps or the stock is the driver of this, not so much the short option. But if I'm just gangbusters bullish in the short term, this probably would not be the trade to do because I'm capping my gains by doing the covered call. And that's true with any covered call. Any covered call we look at, any covered call we look at is a choice that you have in terms of how bullish you are. And if you're more bullish, maybe you don't do a cover call. Maybe you do a long call or something like that. If you're more neutral, well, cover calls work for neutral, okay? But once you start to turn bearish, don't do it. Sometimes people have this misperception that if they bring in that premium and they think, oh, that's a nice premium. But what they quickly realize is if the stock drops a lot, you lose a lot more money more quickly on the stock than you ever make on that option premium typically. So cover calls aren't great protection in your account. But if your forecast is moderately bullish, cover calls make sense. If your forecast is mostly neutral, cover calls may make sense. But if your forecast is very bullish, maybe other choices may make more sense. Or if your forecast is very bearish, you wouldn't want to hold that leaps call or the underlying stock in that case. Okay, so that's what that is. That's the trade. That's what we're going to call that poor man's covered call. Can you see why? Because it's going to be a lot cheaper. I'm not spending $7,700 for the contract, and I went pretty deep in the money out a long ways. It's still going to be a little pricey, but it's what do we say, 39% of the price of the stock. That's the name. That's where the name comes from here. So how am I going to do it? What I'm going to do is I'm going to go out and we're going to look to buy. We're going to buy a, what do we say? We said I forgot, 50 strike. I wrote it down. Hold on. Wrote it down. 50 strike, 87 delta. Yep. So I'm just going to click on that. And I'm going to go to my shorter term options. I'm going to go out 30 days. I'm going to hold down my control key. And I'm going to sell. We're going to go out to about a 30-ish delta, 81. This has dropped a little bit here. And I'm going to sell this one. I'm going to hold down my control key. There is the trade right there. That's the trade right there. Now, how are we going to manage this once we're in it? Well, there's different ways. One is if we're bullish on this and I cease to be bullish, then I'm going to probably get out, right? You don't want to hold on to trades necessarily to the bitter end. If you're doing a bullish trade and you turn bearish on this, and maybe, I don't know what it is, maybe if Nike breaks down below, say, the 70 level, we're going to start to say, well, this isn't looking so bullish anymore. Maybe I'll go a couple percent below that. So we'll say about $69, $68, we'll get out of that. Well, we can do that, okay? We can just make this a first triggers sequential order. I can right click on this. I can create an opposite order, and this one's going to get me out, and it's going to get me out of the whole thing. It will buy back the leaps call. Excuse me. It will buy back the short call, okay? The short-term call as well. It will sell the leaps call. I'm just going to make that a market order. Make that good till canceled. And I'm going to click on the gear. And we're going to say, well, if Nike marks less than or equal to, what do we say, 68 bucks, I think, we're going to get out of that trade. I'm going to save that trade. I'm going to confirm and send that trade. And I'm going to put this in I'm going to just put that as my long stock bucket here. Now, let's go and let me just address questions here, because Josh says a question. Can you also address options available to the investor should the stock price fall and selling future call? Okay, yes. All right. So that's good, Josh. Let's talk about that. Let me send this first of all. Make sure you read the red notes down there on that. Okay. So let me just send this. So let's just talk about management of this. Now we put an exit. We're saying on this trade as is, we're going to look to get out. I think we said, I don't know, 68, 69. If the stock goes down below where basically that yellow line is there. And we sold initially an $81. We sold an $81 call. Well, what if, let's say Nike drops down, we don't get called out, but Nike now next month is down at 72. Is that good or bad? Well, that's not very good. It's not the end of the world because we brought in a little premium. We bought the stock at 76. The premium kind of lowers our overall cost input at that point, a buck below that, but we're losing money at that point. Okay. But then we're looking to sell again. Okay. We're looking to sell again. And we look again and we go, well, let's look at that 81 strike. But you know what we're going to see? And this is what Josh is bringing up. We're going to see that 81 strike is probably like a 10 delta at that point, maybe. And the premium is very minimal on that. So the 81 strike is probably not viable at that point. At that point, maybe we go ahead and sell, I don't know, I'm just kind of making this up. Maybe we sell a 78. Again, we may stick with 30 days out or somewhere in that range. Doesn't need to be exactly 30 days out. Somewhere between 20 and 40 days, maybe, something like that. Okay. And so then you end up doing that. We sell in the lower price. Now, what does that mean? Well, there's pros and cons. One, by selling the 78 instead of the 81, we're getting more premium. That's great because the 81 at that point is like no premium. But we're also agreeing to sell our stock for 78 now instead of 81. Let's say we do it again the next month and the stock is low and this time we sell the 75 or something like that. Well, we sell the 75, we bring in another premium, but look, the stock is now below. We're agreeing to sell the stock below our initial purchase price on that. Well, hopefully the premium has help offset that. So this is not a trade without risk. And ultimately, we may end up selling for less than our purchase price. Hopefully, the premiums add up to the point that it's made it so that we're not losing any money, but there's certainly no guarantees on that. And so, yeah, that is a challenge with this trade. And Josh, I'm glad you brought that up because that is a situation that you can be in. Okay. Any questions on that? Now, let's say the stock, then we sell that 78 and the stock goes up to back to 76 or something like that at that point. Then the next month, we may sell out at, I don't know, 82, or if the stock goes up a little higher, maybe we sell a even higher strike. So each period, you can adjust, do these micro adjustments. And by the way, that's one reason why selling the shorter term calls is advantageous to selling longer term calls. Because one thing about selling shorter term calls is, yes, you're bringing in a lower premium. Okay, that's not great. You want the higher premium, right? But it allows you to make these little strike price adjustments along the way. Okay? And so I by no means do I want to present this as a foolproof trade or anything like that, because you have the issue, we have the issue of the stock going way down and just stopping out essentially. We also have the issue of the stock going down enough that we've got to lower our strike price. So good job on that. So, but the general management on this is this. This is a longer term trade on Nike. As long as we're bullish on Nike, we're going to keep on adjusting that that strike price up. Okay. At the if Nike turns neutral, it's still okay, just like a cover call. We may kind of make some slight adjustments in the strike price. And if we just become bearish on that, we're just probably going to exit the whole shebang there. All right. Now, I want to get to management of other positions here. Let me just see. Now, what kind of stocks are we looking for? I picked Nike because it seems like the trend was going up and seemed kind of bullish from a technical standpoint. You can go through and look. And basically, the types of stocks that you would consider doing this on are stocks that are you deem to be bullish, but not super bullish. How do you do that? Well, you probably more often than not, it comes down to technical analysis for most traders. Now, technical analysis is not the sole means of coming up with trades, of deciding, evaluating a trade. Okay, you've heard us say that before. You've heard Ben say that before too. Okay, technical analysis is not the sole means of investment research. But for this type of trade, a lot of people are relying on technical analysis to a pretty big degree. And so what are the things we're looking for? We're going to be looking for a trend that's going up, probably. Okay. I mean, you can be bullish and not have the trend up, but if you're longer term bullish, but not what you're predicting to be parabolic. Okay. But not what you're predicting to be parabolic. Okay. So I'm going to leave it at that. I think do use your technical analysis. You guys know your technical analysis. If you don't, we have classes on technical analysis, including a getting started with technical analysis class that's on Tuesdays, 2:00 Eastern time, to help you with trend and support and resistance and that kind of thing. All right, so let's go and let's look at some management of particular trades here. So let's go and let's just start with I want to look at Caterpillar here, and then I want to actually go to some short verticals and look at that. But Caterpillar is a trade we've been doing great on. This is a deep in the money option. And when we talk about management of this, there's a few choices. If things are going well, obviously, if things are going poor, maybe we decide just to get out. But things are going well. Are we still bullish on this trade? Okay. Are we still bullish on this trade? Well, you can look at the chart. We can look at that Caterpillar chart. Here's Caterpillar. Technically, doesn't seem any reason to be bearish on this, but maybe we want to protect ourselves. We do have earnings coming up, and remember, stops don't guarantee an exit there. But there's kind of two possible ways if you decide you want to stay on the stock. If you still want to stay with the trade, the general trade, there's kind of two major ways to do it. One is you can check out your stop loss and possibly adjust that up. Another way is to roll this out. Right now, our delta on this is about 81. So sometimes what we'll do is we'll just roll that. We'll pick another strike, maybe even the same expiration day, but roll it from an 81 delta down to, say, a 65 delta or something like that. If we were to do that, we'd bring in a premium. In fact, let's go, let's just look at this fairly quickly here. We got Caterpillar. Let me pull up this trade and just see. Let's say we rolled this from this is showing 82 delta here, about we'll just say 125 down to say a 65 delta down to $7,200. So that's $12,500 down to $7,200. That's quite a premium we'd be bringing in, quite a credit we'd be bringing in. So That's certainly a possibility here. And I want to address that. I'm going to show you that in more depth in future weeks. Right now, though, I'm going to just check out our stop. Where's our stop? Our stop's at about $70 right now. We've adjusted up in the past. Should we adjust it up? What if we look at the current price? The current price is $125. And I'm going to go to like 75% stop on that. I'm going to go 125 times 0.75 gives me a 93.75 stop. Okay, 93.75 stop. So I'm just going to adjust this stop up. So I'm going to click on that. I'm going to right click on it. I'm going to cancel replace order. I'm going to leave it all basically the same, except I'm going to change the stop from $69 to $93, and I think we said 75 cents on that. Confirm and send. This is going to replace the other order. Okay, so there we go. We just canceled the other one. We put in this new one, and when we look at this trade here, I've got now when I look at this stop, I've got my stop moved significantly up. It's much tighter. So those are two kind of approaches that you could use if you have something that's kind of a deep in the money call in terms of trade management and things are going pretty well. One is you can adjust the stop. We just talked about that. We talked about possibly rolling to a lower delta, okay? And in that case, rolling to a lower delta and bringing in a credit there, all right? And then, of course, you'd have to readjust your stop at that point too, as well on that, and taking that off the table. We'll address that a little bit more in the upcoming weeks there. Okay, let's do another one. We got Starbucks. We're losing money on our Starbucks trade. This is a shorter term trade. It's a call. We're bullish on Starbucks, but we only have 9 days to go to expiration. Okay. So typically, look, it doesn't really matter that much at this point if we're still bullish on Starbucks because it looks pretty good because we're getting so close to expiration. We do have earnings coming up, by the way, on that. So what I'm going to do is once we get about a week to go till expiration, we're just going to close out of that. So let me just cancel this order. And just remember on all these trades, let me right click on this. I'm going to create a closing order on this. On all these trades, that should get us out. Have your exits if things are going well. Know when you're getting out if things are going your direction. Know when you're getting out if things are going against you significantly. And know when you're getting out if things are going your way. Okay, that's true for long calls. It's true for short verticals. Okay, let's look at Apple here for a sec. Okay, Apple, I've got 23 days to go. How are we doing? We're losing money on Apple right now. This is a short call vertical. The stock is at 213. The strikes are 220. So we really want at expiration this to be below 220. This is a bearish trade, a bearish to neutral trade, maybe we should say, because if it goes sideways, that's great. We've got time decay helping us out on the trade, okay? Almost $10 a day, time decay helping us out. So what's our exit on Apple if we're just, that's not Apple, if we're just unabashedly bullish? Well, if you are, you may just get out right now. I'm kind of going with the, and honestly, with the trend right now, you could just say that we're bullish on this. I'm going to get out right now. That would certainly be justifiable. I'm going to hold on and say, I think this is a resistance level that is likely to stick. Therefore, I'm willing to stay with that trade. Now, what if Apple just goes way down? Well, we have a short call vertical. That's great. Okay. In that case, we're making money. If we make, I don't know, 80% of what we can possibly make on that trade, then we'll likely get out of that trade. Is that the case right now? That is not the case right now. In fact, we're losing money Okay. We're not making money. So that's not the case. What if the stock's just kind of going sideways? Then we're going to have that rule as well. Things are kind of going okay. They're going okay, but they're not going great. Under 10 days, we're going to look to exit this trade. So I'm going to stick with Apple right now for those reasons. But let's look at another one here. Okay. Let's look at Walmart. Now I do have some orders to exit on Walmart. This is an iron condor here. Okay. This is an iron condor. Remember, when we're managing iron condors, consider managing them as two separate verticals. I have a short put vertical and I have a short call vertical. So let's look at them. My short put vertical. Well, I'm making just barely anything, but it's going okay. The stock's at 95.70. We want it to stay above 91. That's okay. Have we made 80%? No, we haven't made that. We're up $8 on this right now. So we still got 16 days to go. We're probably just going to let that ride. Okay. We've got some time decay helping us out on that. Okay. What about the call spread? Well, the call side of things, we're down $1.50 on this right now, not including commissions, of course, on these. Not disastrous. Stocks at 95.70. And we're below this. Again, I think we're just going to let time decay hopefully benefit us on that and let that go. The goal on this trade is kind of neutral. Let's look at Walmart here. Are we kind of neutral? I'd say, yeah, that's from a technical standpoint. You can disagree. This is seems kind of, from a technical standpoint, kind of more neutralish. No trend on that. So we're going to stick with that. Let's do one more at least. Exxon Mobil. Ooh, what's that? Kind of a weird trade, huh? Kind of a weird trade. This is a short call. Let me get my little drawing tool. Okay. This is a short call vertical and a short put. You may consider managing those separately. This is actually also what we'd call a jade lizard. Not as common a term, but keep in mind, it doesn't matter what we call it. It's what it is. Okay. And we got a short call. Okay. So this is a neutralish trade. The stock right now, which is about just a little bit under 110, is in between our short put and our short call. That's good. If we're bullish, if we want this to be mostly neutral. And I'd say, it's kind of a roller coaster, but more or less maintaining neutral. So that looks okay. Have we made, so I would attack it the same way. Have we made 80% of what we could make on that? Yeah, Jade Lizard. Correct, Laura. Have we made 80% of it? Well, we sold, the original trade was 138 on the short put. At the current price, we've made most, or maybe just a smidge over half of what we can make on that. But we haven't made the 80% on that. And we're not bearish on that. So we're going to let it go till it goes to 9. Well, we're under 10 days on this, aren't we? So we're probably going to look to get out on this just because of time. Okay. So we're not exiting because of price action. We're exiting because of time. We've done fairly well on this. We made $114 on that, unrealized at this point. We would go through the same equation here. Our initial price on this, if you want to look at it as a whole, our initial price on this was, we sold the call spread for about 76, 77 bucks. We sold this for about 138. We sold it for about 210 overall. That's the most we can make on it. Right now, we're up about 113 on that. So because it's 9 days to go till expiration, I'm going to look to get out of this trade. We're going to exit that. Now, I'm out of time, so I'm not going to actually exit right now. I'm going to exit as soon as I'm done with this session. One last little caveat on this. You may decide not to exit the whole shebang at once. It may be easier to exit the put trade and then the call trade separately. Okay, we're going to do that. There we go, everybody. That's it. Thanks, Ben, for helping me out in chat today. Always appreciate Ben. Coming up next, we've got trading price patterns. Okay, all right. Thanks for joining me, everybody. Thanks for your participation, and we'll see you all same time next week. Bye-bye.